You wonder, okay, why do I worry about my money? Well, you worry about your money because your most basic questions about retirement have never been answered. Literally, have never been answered. And yet, you still plan to retire, or worse, you've already retired without your most basic questions about retirement being answered. So is it worse to plan to retire without these answers, or is it worse to have been retired without these answers? Way worse to be retired without having these answers. So you worry because your most basic questions haven't been answered. Things like, when can I retire? Or if I've retired, should I have retired? How about, have I saved enough? Have I hit that magic number? Can I guarantee I won't run out? How much will I lose in the stock market crash? And can I protect my assets against losses? How much income can I safely withdraw out of my assets? And how long is my money really going to last? When I start drawing my money out, how much tax am I going to pay on these distributions? How can I fight inflation with all the crazy things coming on, and if tariffs jack them up again, how do I actually have enough money to spend? When am I supposed to take Social Security? I asked 10 different people, when am I supposed to take Social Security? And I get 10 different answers. When am I really supposed to do it? 11 is a big one. Can I start spending my money? Because every one of our clients is a really good saver. They save, they've been frugal, they've done without. And the worst thing for a saver to do is thinking about doing what? Spending their money. So we have to design a plan that states in writing that it's okay without guilt or worry or remorse that you can start spending your money. What am I really paying my fees? Not the 1% the advisor says about 1%. What am I really paying fees? What if my spouse or I pass away? Will we be financially secure, and will the surviving spouse have enough knowledge to take care of the plan? And then after everything's said and done, I've used my money for the last 30 years, and then I pass away, can I still leave money to my beneficiaries? Every one of you in here has one or all of those questions still on their minds that have gone unanswered. And if you move forward retiring, or if you're already retired and you can't answer these questions, it means you're basing your entire future on hope and luck. You're hoping you're going to get lucky. You cannot base your future on hope and luck. So, what's the biggest mistake retirees and pre-retirees make? It's in retirement or within 5 years of retirement, they think they can do the same things they did with their money that got them there. But you can't do the same things with your money as if you're 30, 40, or 50, because you're not 30, 40, or 50 anymore. You can't take high risk just hoping that you're going to get these big gains, because are gains guaranteed by taking high risk? No. Focus on growth instead of income, because during retirement, the most important thing is to generate income. It's the only thing that will sustain and enhance your lifestyle. Not creating a high level of guaranteed lifetime income, because the only thing that will stop your biggest worry, which is the fear of running out of money, is to get as much guaranteed income as you possibly can that won't run out for as long as you live. Not having an actual written plan, trusting verbally what your current advisor or yourself tells you. Continue to believe time's on your side, and I know we all want to think we're 20, we're no longer 20. We have to know right now at this point, time is no longer on our side. The best thing to do, if you're retired or within 5 years of retirement, is to get an accurate measurement right now of where you currently stand financially with your current assets and current age. Where are you at? Are you at a point where you should feel successful or not? We call this remodeling your retirement, because your current plan is kind of like a 30-year-old kitchen. And the 30-year-old kitchen was well for you. It did great. You still can cook in it. You still can eat dinner, and everything is great. But you know you need to remodel it right now. And your money, just like your kitchen, needs to be remodeled, because you need to enhance your plans for a successful retirement. So let's look at retirement remodel number 1. This is a couple that came in, and they weren't our clients, and they said, okay, we want to find out about planning. Well, they wanted to find out planning because it's not just so they start thinking, I'm going to do planning today. They had lost $300,000 in the market. So they're 67, retired since 62, and they've been invested without them knowing it very aggressively, because all stocks in their portfolio. That $2.5 million of assets, they had planned to do a $200,000 kitchen remodel, $100,000 new purchase on a car, and have $100,000 of income off of the remainder. And the kitchen remodel is kind of hits home for me, because we're just finishing up our own kitchen remodel. I know it costs a lot of money, and if we would have lost a lot of money, we wouldn't have done it. We didn't lose any money in these market declines, so we moved forward with our kitchen remodel. But after the market chaos, the portfolio dropped to $2.2 million. Remember, they had 2.5, and they don't feel that they can afford to do the kitchen or the car, because that was going to cost the $300,000 that they lost. So would they even think about doing those things now? And they wouldn't, because they don't have a plan. So I just asked them a simple question. I said, what if you could still do the remodel, buy the car, and have even more income per year than you had planned for before the losses? And of course they thought I was crazy, but they said of course they'd love to do it, but they didn't think there's any way possible that could happen. So we just did a simple plan. This is the end game after all of our work. We repositioned the $2.2 million to still allow them to have the $300,000 to do the $200,000 kitchen remodel, $100,000 car. So they got what they wanted, because that's one thing my partner and I love to do, is to make sure we enhance our clients' lives. If they can't do the kitchen, they can't buy the new car, are they going to be really happy or unhappy? They'd be unhappy because they planned on these things. It was things that they wanted to make their life better. And then we used the remaining, only $1.9 million of assets to provide them $125,000 of income per year for as long as they both lived, and they had wanted $100,000. So did we then remodel their retirement plan? And we did. How about this one? This couple lost $400,000. John and Diane, both 62, planned to retire at 65. And they've been aggressive because they knew they were young enough they could make up losses. The problem is now they're 3 years away from retirement, and they had $2 million of their IRA 401k assets. They had a bunch of other assets on top of that, but they wanted to use their IRA and 401ks for income because they didn't want to pass those assets on to the beneficiaries and force the beneficiaries to pay taxes on them. They both now still, in their hearts, they feel like the 1.6 million needs to get back to 2 million, because when clients like you lose money, the one thought they have is, how do I get back to even? And I don't want to make any changes or adjust anything until I get back to even, because I need to get all those losses back, because that was my money. Well, if a loss happens, that means it wasn't your money. The 1.6 is your money. So they feel they need $2 million. They hope they'll recover, but there's no guarantee the 1.6 million will grow to 2 million by 65 in just 3 years. They said they'll have stress and anxiety over the next 3 years. And I asked them, okay, when will you recover so you can retire? They said, we have no idea right now. So that means they can't retire then. So I asked them a simple question. What if your 1.6 million of lower current asset values would be guaranteed, not maybe, not hope for growth, guaranteed to be worth $2 million for income purposes, not lump sum, but income purposes in just 3 short years, even if the stock market recovers, because remember, you wanted the $2 million to provide you income. They both stated this would be completely solved the dilemma, but they said there's no way that can happen. So we repositioned their 1.6 million to contractually guarantee after 3 years at age 65. They'd have a guaranteed income base of $2 million, and they'd be able to use that to create $140,000 of income per year for as long as they both lived. So their retirement plan has been successfully remodeled. We call this our fake and facts, and this really was stolen from the first time Trump ran for presidency, when it was the fake news thing. So we say, is this fake or is it fact? Well, this is back in 2022. Druckenmiller came out and said there's a high probability the stock market will be flat for an entire decade. Not that it'll be like this, but it'll go like this. In 10 years down the road, when you look at it, it will be a 0% rate of return. A month later, Weinstein came out and said, well, I think it's worse. I think the U.S. could be in a 30-year Japan bear market based on where our economy is, where our national debt is, where interest rates, where inflation is, and where the economy is. Meaning, we'll crash, and it'll take 30 years before we now get back to even. How about this one? According to a recent survey, 90% of Americans say that money is having an impact on their stress levels, giving them anxiety, and 34% are losing sleep over it. Well, I think 90% is right, but I think 34% is low based on how many people call our hotline at 1:30 and 2 a.m. in the morning, meaning they're awake. This one, 61% of Americans say they're more scared of running out of money than dying. And that makes sense, because if you're dead, do you have to worry about your money? Don't got to worry about it. You're gone, only if you're living. Goldman Sachs never wants to say one thing negative about the stock market, because their business is of the stock market. They say the next decade, and this is as of October 2024, about 10 months ago, S&P will only average about 3% gains per year for the next 10 years. That's before fees, taxes, and income. And that's because more than 1/3 of the index is made up of just 10 stocks. What if of those 10 stocks, 3 or 4 of the stocks don't do well? What happens to the entire index then? Brings the rates of return down. Doesn't crash it, just brings the rates of return down. And it's happened historically every single time in history that this has happened, the rates have been compressed. Rockefeller says American stock market boom will end in 2025 as markets punish the U.S. for its enormous deficits. Well, we already got downgraded from the highest credit rating. And now you look at what's happening right now. Are foreign countries going to either buy our bonds, or are they just going to sell the bonds? What's going to happen? We don't know. Are you going to work till you drop? Because the average retirement age keeps rising due to longevity and the fear of people outliving their money. Very few people get substantial, if any, pension income. They don't feel like they've saved enough because they don't know what their magic number is. And they have no idea if they can or should retire because they don't have a plan. They have assets, they don't have a plan. And I should have probably talked to you and warned you that a lot of the data I'm covering you right now is in a section of the workshop I call appetite suppression. because I have to pay for your food. If I can suppress your appetite, it costs me less money. And I usually do a pretty good job of this. Right? Anyone ever hear of Robert Shiller? He is probably the most brilliant man on the stock market that Jim and I have followed. And he won the Nobel Prize for his Shiller CAPE ratio. And the CAPE ratio is basically a historical price-to-earnings ratio that's been adjusted for inflation. So instead of just using the prices of stocks compared to the earnings, he's adjusted everything for inflation, which gives you a true view. He goes back to 1871. And this isn't the graph of the stock market. This is the graph of his CAPE ratio, which shows the price of stocks as compared to the percent of earnings each stock has. So the average since 1871 over here is 17.17. Okay? You notice then, every time the CAPE ratio gets substantially above that, what happens? It comes down. What that means is the price of the stocks come down as compared to the earnings, which means the price of the stocks have crashed. So that happened in the early 1900s. It happened. No one talks about the huge gain from here to here before the Depression. Do they ever? Huge gain. But what happened then? It got so high, it crashed with the Great Depression. 60s and 70s, 2001 and 2, 7, 8, 9, 2022, and as of June, the CAPE ratio is at 36.06%. When the average has been 17, and anytime it's above up here, we have a problem. So what do you think is going to happen? We know what's going to happen, it's just when. We know it's going to happen. We just don't know when. And if you look at this, there's only 5 other times in history that the Shiller price-to-earnings ratio is top 30. Only 5 times since 1871, and every time it has done it, the S&P, Dow, or NASDAQ has all lost between 20 and 89%. Okay? So am I doing a pretty good job of suppressing your appetite? How about Berkshire Hathaway? Warren Buffett warning. They have $350 billion or more in cash that he's been accumulating over the last 24 months because he's waiting and he knows the market's going to crash. He's keeping the cash. He doesn't care. He's waiting the market crashes. He'll put that money back into the market. And is anyone in this room smarter than Warren Buffett? Nope. So let's get to some of the data we created. And we call this the 2 myths of riding out the stock market, hanging in there no matter what, and getting a 12% annual rate of return every year. And that's exactly what you should have believed before you retired, or as long as you were 5 years or more before retirement. Okay? You should have. You should have done that. You should have hung in there, rode it out no matter what. That was the right thing. But now at retirement or getting ready to retire in the next 5 years, you cannot hang in there and ride out all losses, and you're not going to get a 12% annual compounded rate of return in the market every year for the rest of your life. Well, let's look at why. This is the S&P 500 from January 2000 for 25 years up to 2025. The market started at 1469, S&P 500. It ended at 5881, so almost 4 times growth. And if you hung in there and rode it out through all this risk, you got this huge gain because the market went up from 1,400 to almost 6,000. So you got that 12% rate of return, right? Nope. That's a 5.71% annual compounded increase to the S&P 500 index for that 25 years time period. So was a 5.71% increase to the S&P before fees, taxes, and income worth all the volatility and risk we took during the time period? And every single person has to answer, no, it's not worth that. Well, how did it happen? Why did it work this way? Well, if you go back to 2000, the market just doesn't crash and come back really quick. 2000 technology bubble, it went down 50%, not at once. It went down about 10 to 12% in 2000, and they said, hang in there, ride it out, you'll be okay, don't worry, you're gonna get huge gains. You did, and then you're wondering why your $1 million went down to 880,000. In 2001 then, it went down about 13 to 15%. And they said, hang in there, ride it out, you did, you lost another 150,000. And then they said, don't worry, it won't go down any further. Well, then 2022, it went down about 24%. And at the end of this 3-year time period, you're like, how in the heck did my $1 million go down to 500,000? It's because you lost 50%. All of our clients are really smart people. They're successful. They saved a lot of money. Otherwise, they don't become our clients. 90% of them think if they lose 50% and the only goal they have is to recover, because once they lose it, they want to recover. They think if they lose 50%, it's fair and logical that they only have to make a 50% gain just to get back up to even. And mathematically, it sounds fair and logical, but mathematically, it does not work. You need to make 100% gain once you lose 50% just to get back up to even. Okay? And at this point, it went down and it did recover fully, right? It recovered 100%. And you're so happy. You're like, oh, gleeful. I'm so happy I finally recovered all my money. The issue is then that means you're happy that you made 0% for 7 years. Did you realize that? Okay? And then they said, don't worry, this is an anomaly. It'll never happen again. We're going to prove that's not true. In 2007, 8, 9, if you remember the great financial crisis, the market went down another 50%. took that 16-month time period, and then we needed another 100% gain. So we started at 1469. January 13, 2013, 13 years later, we ended at 1462. So how much did the index go up by during that 13-year time period? No one can challenge one of these numbers. It's just what happens. And what I'm telling you right now is kind of what you thought. It's just no one else would agree with you that, yes, what you thought was true. Now, here's the key. Some people, some of our clients will argue with us. They'll say, Dan, we like all the numbers, but during this time period, my account grew, and it grew substantially during that time period, that 13-year time period. It wasn't flat. I go, well, it probably increased in the value, but it didn't grow because the stock market didn't allow it to grow. The reason your account increased in value over that 13 years is because you're working and you're a good what? Saver. And didn't you always think that only gains you were getting in your head were coming from the contributions you were making? Every single one of you thought that at some point in your lives. Now that's just one time period. So let's now be anal retentive and look at all of the last 15-year time periods from 1996. And I call this the 12% assumed or stated stock market rate of return, because either if you're doing it yourself, you're assuming you're going to get a 12% rate of return, or your broker says, oh, our goal is to get you 12%, don't worry, that's going to be manageable. We call it an urban legend because it's not going to happen. Why? Well, we do the research. We don't say things. We went back and looked at the index itself, the S&P index, which is what you see on the news when they report the S&P dropped 200 points, went up 300 points, whatever. That's what they're reporting on. And we looked at every 15-year time period and calculated out what the actual annual compounded rate of return was for each of the 15-year time periods per year. And the average was 5.99. So they always tell us we're going to get 12 up here. How are we going to get 12 if the average has been 5.99? It means we're not. So when we do projections, when we have clients' monies in the stock market, we're not going to project more than a 4% growth rate as we're taking income distributions to make sure that it's safe, and we're going to plan for the worst case scenario. The only time we came close to 12%, earning 12% for 15 years, was in 2009 to 23, 2010 to 24, because these time periods started after what? The 2008 financial crisis, where the stock market went down 53.1%. So you invested at the single best time in history you could have invested, other than the Great Depression. Okay? How about this? A lot of people like to talk about bear markets, bull markets, the good things. Jim and I like to talk about bear markets, the bad things, because we're retirement income planners and risk mitigation planners. That means we can't plan for the best case scenario, because what if we plan for the best case scenario, it doesn't work? Is your plan going to work? We have to plan on the worst case scenario. And we will always only plan on a worst case scenario, which means we have to look at all the negatives. So we're very optimistic people, but when it comes to planning, we're going to be the most pessimistic people in putting your plan together to make sure if the worst case happens, your plan's still going to work. Is that okay with y'all? I usually will say yes. So let's look at all the bear markets since 1929. Bear market is when the stock market goes down from a high point 20%. A bull market is when the stock market goes up by 20%. And you probably don't know this, but they call a bear market a bear because a bear market is bad. A bear can eat you. They call a bull market a bull because you can eat the bull, so that's a good thing. So easy way for you to remember. The good news is, though, there's only been 17 times since 1929 that the stock market has gone through a bear market. Well, mathematically, the problem is, even though it doesn't sound like that many for the last 100 years, it means it happens every 5 years. And when it happens, it doesn't just all of a sudden crash and come back quickly. It takes 18 months to go from high to low. You almost don't realize it until the end of the 18 months. You're like, oh my gosh, how did I lose 39% on average every 5 years? So let's say you're 60 and you're married. There's a high probability one of you is going to live to 90. So how would you like to know right now, based on history, if you have your money invested in the stock market and you're 60, one of you is going to live to 90s, that means you're going to go through 6 more 39% losses. Markets like this, you're trying to navigate through the losses while you're trying to not lose too much and use income from the assets without the assets running out. What chance do you have, you think that that's going to work? Pretty much zero. How about bubbles? You know how when you talk to your broker or you look it up yourself and they say, oh, don't worry, this is just a bubble, the tariff thing, the Shiller ratio, it's just a bubble. It'll crash quick and it'll come back quick. Well, instead of listening to that jargon, let's look at facts. Let's go back to the second bubble, which from this point going back, which is the S&P 500 information technology bubble, and that would have been Y2K. The index, which was all technology companies, had a high in March 2000, hit a low in October 2002, did not recover until 2017. 6 to 300 days, or 17 years, 3 months, and 22 days. Why is that important? Well, what's our current market based on? Is it based on technology or non-technology? Way technology. We're in the same position right now as we were sitting in March of 2000. Right now, it's the same scenario. Well, do you have 17 years, 3 months, and 22 days to wait to rebound from your losses to recover before you start using your money in retirement? No. If you're 40, you do. If you're 60, you do not. And then they say, oh, don't worry, that's an anomaly. Well, let's look at the S&P 500 financial index in the 08 financial crisis. Hit a high February of 7, a low March of 9. Did not recover basically until 2020, about 4,700 days. Do you have 12 years and 9 months from this point? Let's say you're 60. Can you wait until you're 73 to use your money and have a really happy retirement? The answer is no. And again, appetite suppression working pretty good? Good. Now we're going to cover Warren Buffett's rules for investing. Rule number 1, when he did a famous speech about 15 years ago, and he was trying to get the crowd, because the crowd was like it is now, they're worried about the money and things were happening in the markets. He was trying to kind of lighten it up. So he said, my rule number 1 is never lose money. Rule number 2 is never forget rule number 1. And when he says it, he said it tongue-in-cheek, because you know if you invest money, you got to take risk. What he's really saying is make sure you know how much risk you're taking and never take more risk than you want to take. The problem is that did not quantify anything at all, but it's a really good philosophy. So Jim and I sat down and we said, how do we quantify that philosophy and make it so consumers, retirees, and soon-to-be retirees can understand it? So we literally invented the golden rule, 5 to 10%. And what this does, it teaches the losses very hard to recover. So if you're in a no loss limit, and many of you are, I would say in this group, 90% of you will have a risk factor of 40% or higher. What does that mean? That means if the stock market crashes like it did in 2001 and 2, 2007, 8, 9, you better plan on losing 40% or more of your assets. So let's just say you're invested in stocks and you're diversified so you don't think you have that much risk. Or worse, you have stock mutual funds or index funds and they tell you they have less risk than the stock market. Well, if you have that, let's say you have an S&P 500 index fund and the market goes down 50%, how much do you think you're going to lose? 50%. So if you have $1 million and the market goes down 50%, you lose 500,000. You're down to 500,000. If you only get a 50% gain on your 500,000, you're not back to even. You're only back up to 750. You need a 100% gain on your 500,000 to get back up to the $1 million. And that's assuming you're not taking any income distributions, paying any fees, or paying any taxes on the money. And how long, for sure, will it take to make our 100% gain back? No one knows. If you're taking income out of it, it might not ever happen. But what if you only lose 40%? You still got to make a 67% gain. So we never want to be in these red plans. In fact, we will never create a plan if you, the client, makes us be in a position where we have to try to make these huge gains. We won't do it because we can't tell you for sure it's going to happen. So instead, when we design a plan, we're not going to have you any more risk than 5 to 10%. 95% of our clients have 5% or less risk in their portfolio in writing, which means if the market crashes 50%, instead of losing 500,000, they'll be projected in writing to lose 5%. They still have a loss, but it's 50,000 versus 500. Their 500,000 remaining balance actually be 950, and 950 only needs to earn 5.3% on the 950 to get back up to even. Is a 5.3% rate of return easier to get than a 100% rate of return? And if we go down to 500, can we really take any income off of that before it recovers? If we go down to 950, can we continue to take the same amount of income we were taking out before the loss? Across the board. Okay. So that's the end of the stock market data, other than, I always say there's one thing worse than the stock market loss, and that is, if the market goes down, I believe it will always 100% rebound. My partner believes it will always 100% rebound, which works fine if you're in the accumulation mode. Does that philosophy work if you're 60, 65, or 70? And the market acts like this, which it can again, which it has again. So the only thing worse than the stock market loss is paying high fees, because if your advisor doesn't tell you the actual fees you're paying or you don't know, does the advisor ever say, oh, I'm so sorry, here's your money back, I overcharged you? No, the advisor never does that. So what could you be paying in fees? Well, the advisor might say you're paying 1% in fees total. Well, that might be what you're paying them, but you also might be paying 1% in a money manager fee. If you have any mutual funds, index funds, ETFs, you're going to have fund expenses. If you have actively traded funds, the average cost is 1.01%, which some of you might. And then there's a hidden cost. The mutual fund expense, they have to show you in the prospectus. But the trading costs, they don't have to show you. So we estimate what it is based on industry data. And the average trading cost is going to be 0.75% when they buy and sell. Because let's say you have a mutual fund. And the mutual fund manager is going to tell you, hang in there, ride it out, you're in it for the long run. But I have 100 stocks in my portfolio, and I have to sell a few of those each year, and I have to buy a few of those each year just to replace the portfolio. So what is a reasonable percentage when they're telling you not to sell 1 penny? What's a reasonable percent that I'd be selling out of my 100 stocks? No one will guess that it's between 80 and 100 of the stocks I'm going to be selling and repurchasing every year on average in an equity fund. So I tell you to hang on and don't sell them, and yet I'm buying and selling 80 to 100% of it, which is going to then cost these trading costs. And if you have these older types of funds, there's cash drag inside the funds, which could cost 0.83. So the poor client thinks they're paying 1%, could be paying 4.5, but the average when we do an analysis and a fee audit is about 2.5%. So if you're told you're paying 1% and you're paying 2.5%, what's that going to do to the chances that your plan's going to work? It's going to decrease them. Might not eliminate them, it's just going to decrease them. How about this one? You were told when you started saving 30 years ago, save money, and by the time you retire, you can take out a certain percentage and you have a high probability or never run out. Well, it's always been based on a 95% probability, what they call 2 standard deviations. And it means if you don't take out in the 1980s more than 6% of your million, you have a 95% chance your 60,000 will never run out, which doesn't make sense to me when they say safe, because you still got a 5% chance you're going to run out. And do you really want a 5% chance you're going to run out in retirement? No, but that's just the numbers they give us. 1990s dropped to 5%, 2000s. Right now, we're sitting at about 3% if you index it for inflation. So every million, if you can only take out $30,000 safely, what's that going to do for your lifestyle? The answer is nothing. Yeah, the answer is nothing. So why are we talking about this? Well, let's look at, you have $1 million asset, and most of my clients, they're very smart people. I agree with them. Seems like you should be able to take out $50,000 a year of income. Paying 1% to your advisor, and if you're paying 1% to your advisor, you're fine, but you forgot you're paying 2% in fees, potentially to the additional cost. And then if we're trying to get S&P 500 rates of return, the good and the bad, you got to get the reds and you got to get the whites. You start with $1 million. First year, 2000, stock market goes down 10.14%. They say, hang in there, ride it out, you do. You lose 101,000. Take out 50,000 of income, pay your advisor fees you didn't even know you're paying, end up with 818 at the end of 1 year. Year 2, you start at 818. And why am I showing this? Well, the stock market right now, the technology market is poised just like it was in 2000 at ultra high points with ultra high price to earnings ratio and with unbelievable amount of risk in it, just like we were in 2000. So 2000, 13% loss, hanging the right out, you do, 106,000 loss, income fees, you're down to 637. 2002, market was down almost 24%. They say, hang in the right out, you'll be fine. You do, you lose 148 income fees. You're down to 419 after 3 years. Are you fine? There's no way in heck anyone would judge that as being fine. But they'll come back and tell you, hang in the right out, the market would always recover, which we know it will. This is what happened. And the market from here, after those losses, the market 100% recovered at that point. Why didn't you? Why at that point, even though you earned these great rates of return, had 467, at the end of 5 years, you're down to 339. It's because you're earning those rates of return on what? Hardly having anything left in your account. It's because you're using your assets for income. Now we got 339 left, 2008. Market goes down 38%, hang in there right out. You do, you lose 139 income fees. You're down to 148. They say, don't worry, hang in there. It'll be fine. The market's going to get huge rates of return. They didn't lie at all because the market fully recovered. And did the market get huge rates of return? Huge rates of return. But you're earning these rates of return on what? Having nothing left in your account. And by 2012, you were literally out of money. No more assets, no more income. And you weren't even able to participate in the 3 back-to-back-to-back best years, which were 2019, 20, and 21, because you already ran out of money too early. Okay? So that's the end of appetite suppression. How did I do? Okay? And we want you to make sure you feel what we were talking about, because this is your life. You don't get any do-overs when it comes to planning at retirement. Make one mistake, you're done. So we now think it's time for you to be able to stop worrying about your money. So now I'm going to give you some answers, because I have a minimum. I have to pay for your food if you eat it, if you don't eat it or not. So I need to build your appetite back up. So what do? We're going to tell you in our book, on our radio, and our TV, and you can download our book for free so you don't got to write notes. This is in it. Our 7 rules. We're going to give you all the secrets, 7 rules to live by for retirement security. If you follow these 7 rules, every single American is guaranteed to increase their probability of success during retirement. Some of you just a little bit because you're already doing everything right. Some of you 4 or 5 times success. So what are these rules? Number 1, avoid large losses. Always make sure you use the 5 to 10% rule. What does that mean? Well, of your whole portfolio, let's say you save $3 million for retirement, you got to make sure you never ever, even if the market crash, lose more than 5 up to 10% of those total assets, because then we can continue to survive. And you can't just take your broker's word or your spouse's word. So if your broker says, oh, don't worry, you don't have that much risk, what does that mean? It's not in writing, they didn't sign it. If your spouse says, oh, honey, don't worry, we don't have that much risk. No, you do not believe your spouse. You make your spouse put it in writing as well, otherwise no go. So if we have the risk in writing and we know we have 5% or less risk, how many of you do you think would really worry about your money as far as big losses? None of you at that point. How about the next one, minimize fees? Well, how do you minimize fees? You get in writing exactly what you're paying in fees. And I will guarantee right now, none of you have a written plan that encompasses all of these things, because in the last 40 years that we've been meeting with clients, how many out of the 4,000 we met with do you think actually had a complete written retirement income plan? 3. 3 had them. So that's basically 3 versus 4,000 is basically 0. So that's why I know none of you have a plan right now. You have assets, you have an IRA plan, you have a 401k plan, you do not have an actual plan. A plan then would put in writing exactly what your fees are. How many of you have in writing right now exactly what the total fees you're paying? The fees you see and all the hidden fees you don't see. None of you do. The advisor hasn't provided that to you and it wasn't signed, so you can't trust it. You can't trust verbal things right now. How about this one? Significantly reduce volatility. Over the last 3 years, if you go from February 2022-ish to February 23 to 2025, the market was up, down, up, down, up, down. It was pretty much flat for that entire time period. Then we got a really good gain from that point on. But during the time period of 3 years of volatility, what did all that volatility do for you? Anything? It did something for you. It made you worry about your money. Didn't do anything good, but it made you worry about your money. So we don't need volatility. We need to earn a reasonable rate of return. Some clients will come in and they go, Dan, I know I have to earn a 9, 10, 12% rate of return, whatever. And they're right if they are basing their rate of return needing to recover from their losses. If you have to recover from big losses, do you need big rates of return? What if you don't have big losses? What if instead of 50% loss, you have 5% loss? Do we have to get huge gains to make up for that? You don't. Manage taxation. The first rule of understanding manage your taxation is understanding what tax you're actually going to pay, and do not get sucked into the false propaganda that you're going to be losing half of your income when you retire in taxes. It's not going to happen that way. So you need to do a tax analysis to find out and know that instead of when you're working losing 50% in taxes, how would you like to retire and only lose 20% in taxes? Will that make you all feel a little better? That's one of the rules. Generate certain income from the assets that will last, guaranteed for as long as you live, not maybe income that could end at any time. Jim made up that term maybe income, and I think it's cool because you want to make sure that the income you're going to get from your assets never runs out, because at that point, if it runs out, your lifestyle changes or it completely is cut off. So we have to make sure your income that you need is guaranteed 100% for as long as you live, not maybe. Maybe income when they say, oh, don't worry, you can take out 6% of your account and the market will be fine and you'll do well. If you take 6% out of your account, what do you think the probability is right now that it will last forever? Probably about 50% right now is the number. And then have a written retirement income plan. Make sure that every single thing about your money in writing. So if you had all 7 of these things, would every single American have a higher probability of success at retirement? The answer is 100%. But again, some people just a little bit, some people a huge amount. So now, how about the big question of the future that you all, if you're not worrying about it, you better start worrying about it. And that is Social Security system potential collapse, confusion, uncertainty, chaos. Associated Press AP came out in June of this year and said the Social Security go broke date is now 2034. And that means not when there's no money left in the system, it means when there's less money coming than going out, so it is going to go broke. And some of the experts are out there saying that they think we're going to have to reduce benefits by a minimum of 25% and could be a lot more just to keep the system afloat. So let's look at Bill and Jane, 65, plan to retire at 67. 67, they're each projected to get $40,000 a year of Social Security, which is $80,000 combined. What if the benefits are reduced? Well, if they get the full benefits, that's what they planned on. Everything's going to work fine in their plan. What if benefits only go down by 25%? They get $60,000. Where in the heck are they going to get the other $20,000 on a very secure basis at that point? What if it goes down 50%, which could happen easily? And now we have $40,000 less. Where are they going to get $40,000 more per year just to catch up to their lost Social Security benefits? What if they go down 100%? What if they start doing needs-based testing on a Social Security, meaning based on the amount of assets you have or the other income you have, and they stop you from getting Social Security simply because you have other income? That makes the most sense, literally, because Social Security wasn't planned for all of us. Social Security was planned for widows and orphans and to last for an average of 6 years. not for everybody. Well, now because we paid in tax for so long, we are due it. The problem is it was a lie told to us the entire time. So with Social Security reform, which whenever they say reform, when it comes out of Washington, we're going to reform, that means they're taking something away from you. Just get used to that. It's on the horizon. The best way to rescue Social Security is to have a 3-step plan. Number 1, eliminate stock market losses from the assets you need to create the income that's going to replace your Social Security. That makes sense? Number 2, create income that's contractually guaranteed to last no matter what happens in the market, no matter what happens in the laws, it'll last for as long as you live. And number 3, have a written Social Security retirement rescue plan. Make sense? You have all those things, you have a lot better chance that Social Security won't hurt you. How about this one? We were told that, no more tax on Social Security benefits. Well, the big beautiful bill was supposed to eliminate tax on Social Security, but as you all know or could guess, it didn't happen. New law only provides a temporary, very few year extra deduction of $6,000 for people that are 65 or older. There is no elimination at all of the Social Security benefits, taxes on it. Currently, up to 85% of your Social Security benefits can be taxed. We've done a calculation, and 100% of our current clients who are just like you will continue to pay tax on their Social Security at the exact same level. So don't plan on a reduced taxes. Now, how about Social Security benefits? When in the heck are you supposed to take Social Security? If you ask 10 different people, you get 10 different answers. Well, we are never going to answer and not have backing behind us. So we're going to do 3 tests to be able to tell you black and white when you should take your Social Security. So the first test we're going to run is what we call the annual income comparison. And it's going to show, based on when you retire and take Social Security, how much you get: $23,962, $33,660 at 67, $41,736. If that's the only calculation you do, and this is almost double that, mathematically, it would make sense to take the most you could get, if that's the only thing you look at. And that's what people say. Defer to 70, you get the most money. Well, is it true if you defer to 70, you get the most money? It's 100% true. It's not necessarily the best thing for you, but it's 100% true. So then we need to take, let's assume each one of these gets 1.5% raises. This just gets 1.5%. Bigger number 1.5%. This gets even bigger benefits because they get 1.5% of a larger number. You think this would always win? Well, let's calculate out how long this would win and how long it would take these other ones to catch up and break even. So if you take Social Security at 62, those benefits cumulatively will be higher until, as compared to 67, you would have to wait until 81. Is waiting to 81 a short-term or a long-term problem? It's a very long-term problem, too long. How about if you said, well, I'm going to wait to 70, you got to guarantee me in writing you're going to live to 84 before it would have been a good decision to take your benefits at 70. So you're not the financial advisors, but if we just now show this second test, when are you already started to lean towards taking your Social Security, if this was your case? 62. Then we do a third calculation. A third calculation says, let's just do a financial calculation and say, you get this amount of money coming in each year, that amount and a lot more, and instead of spending it, you take it, you invest it, you earn 5%. But now you're going to get double, you're going to invest that. Surely this has to win. 62 wins all the way through age 90. 67 and 70, taking that money, investing, getting 5%, a larger amount, 5% that, they never catch up through age 90. So, you're not the financial advisor, but when are you going to advise this client to take their Social Security? 62. Okay. And you can't take this as your analysis. We have to run this personally, so we make sure your numbers fit. But if this was you, we're going to tell you to take it at 62. How about this one? We think this is one of the most important charts we cover to educating our clients, and that's the 2 stages of money in retirement, because no one has ever covered this with you before. Intuitively, you've known that as you get closer in retirement, you have to take less risk. You knew that, and maybe even your advisor has said that, but you haven't been transitioned into stage 2 because you're still stuck in stage 1. Stage 1 is called asset accumulation. This is when you're working. And this is when you're making a salary, you're investing monthly, you desire maximum growth. You can accept losses and volatility. You don't need the assets for income because you're making your salaries. Assets are going to be used at some far distant point in the future when you get old and time's on your side. So this is saying, while you are working in stage 1, you should take as much risk as your gut will allow you to try to get the higher rate of return. But when you're retired, stage 2, asset preservation, income distribution, retired or pre-retired, retired or within 5 years of retirement, you should have already transitioned to stage 2. And stage 2 is when you know you're not going to be making a salary. You're not going to be making any monthly investments in your 401k. You desire the maximum security. You already know intuitively you have to minimize your losses. You want to create secure lifetime income that'll never run out. You want assets to produce income now or at a specific point in the future, and time's not on your side. So what is similar about the blue and the gold ovals?
Time's not on your side.
Trick question, nothing is similar. They're exactly opposite of each other. Every single thing is opposite. So what that means is you can't use the same strategies, assets, and planning for both stages. You can't use the same advisor for both, because if you're an advisor that specializes and is really good at helping you accumulate assets, taking risk, and getting higher rates of return, that's what they're good at. You can't go to that advisor and say, can you create me a conservative income plan that'll guarantee I won't run out? They don't know how and won't do it. Same thing. You can't go to a stage 2 advisor and ask them to be aggressive with your money. Our firm only works in stage 2 because all we work with are retirees and soon to be retirees to mitigate their risk and create income that's going to last for as long as they live. That's what we do. So I always look at this as, let's say stage 1 advisor is kind of like a brain surgeon. And at age 40, you have a tumor, you need to have it excised. You go, he's the best brain surgeon, she's the best brain surgeon, they take it out, you're healthy as heck, everything works, you love the person. Then at age 65, you have a heart problem. Are you going to go back to your brain surgeon to then operate on your heart? No, you go to the best heart surgeons, which would be myself and my partner. We are the best heart surgeons to help you now make the best decision in stage 2. That's how you make the decisions. So, how do you then transition from stage 1 to stage 2? Because it seems like it's an upheaval. It's 180 degrees different. Well, you do it simply. You learn how to control your assets by making your assets act any way you want. Remember that chart of the S&P 500, the green chart that showed all the volatility, and then if you hung in there and wrote it out, you would have made a 5.71% gain. But as long as you hung in there and wrote it out, which means you can't control your assets, you just have to hope they're going to come back. You can control your assets, make them act any way you want by using 3 buckets. First bucket's going to be your liquid bucket, low risk, low volatility, lump sum access, low return and low income. What is that? Bank, savings, money market, CDs. And we're always going to have a gold bucket in our plans. A lot of advisors don't, because they say, oh, you didn't need to have that much liquidity. You didn't need money in the bank. Yeah, you do. Jim and I have a bunch of our own money in the bank, and we're going to recommend you do the same thing, because we don't tell you to put money in this bucket for growth or returns. We have you put money in that bucket for what? Not emergencies, but because it's easier to do what with? Spend. We can spend it. That's what the money's there for. And in retirement, we need the money to be able to be spent. So we have clients that come in, they have $3 million of assets, they have $10,000 here, and they have like $2.99 million in their growth bucket. And I go, are you crazy? I'm like, what are you talking about? You have 99% of your money there? Well, that's what our advisor told us to do. I said, no, that's not going to be a proper plan. Because they think they have to get a good return potential on all their assets, but they have potential high volatility, which maybe they haven't been told, and they can lose some or all of their assets, which maybe they haven't been told. Stock market, mutual funds, variable annuities, real estate, businesses, precious metals, oil, gas, Bitcoin, etc. Now, this is not saying this is good or bad. It's not saying this is good or bad. It's just defining how these assets are and how they work. And then the brokers won't even tell you about the middle column, which is principal protection and lifetime income. That's our middle bucket. This is where principal is fully 100% protected against all losses, contraction guaranteed. We get some of the gain when the market goes up, not all of it, but we never suffer loss. We get income guaranteed contraction for as long as we live, whether we're single or married. That is a low fee, no load fixed index annuity with an income rider. And if you look at what the goal is of planning, the goal is to determine how much money we allocate to the gold bucket, how much money we allocate to the green bucket, how much money we allocate to the red bucket, because then based on how much we allocate to each of those buckets, can we make your money act any way you want for liquidity, income, and growth? 100% you can. Pretty easy when you look at it that way. Well, why? When you look at your current portfolio, you have a pie chart portfolio that has 45, 50 different funds, stocks, etc. And they say you have all these because it's diversified. And you have all this diversification because it reduces your risk. Well, in 2022, did it really reduce your risk if you had a 60% stock, 40% bond portfolio? Or did you lose the same amount of bonds as you lost in stocks? Probably lost the same. So did you have any diversification? No, because all the assets acted the same. We use 3 buckets because these assets act differently. If we put money in the gold bucket, which we're always going to recommend you do, we don't expect you to give a high level of income like the green bucket or a lot of growth like the red bucket, but it better be 100% safe, it better be liquid, accessible, not have any fees, and makes us feel confident that we can use it to spend. If we put money in the green bucket, we don't expect it to be liquid like the gold bucket or high gains like the red, but it better guarantee 100% you never lose principal if the market crashes. Gives you some opportunity for gain, but more importantly, gives you the highest level of income on a guaranteed basis for as long as you live. And if we put money in the red bucket, the growth bucket, do we expect that to be free of risk? No, we expect that's going to have some risk because we have the best return potential. So based on how much money we put in each of these buckets, can you make your money act any way you want? It's pretty simple. The answer is yeah. So how do you do that then? You take these 3 buckets and you create your own portfolio. And it's not that you put 1/3, 1/3, 1/3. I just made it look pretty because before we had a portfolio that had like 20% here, 40% there, 40% there, and people would ask, why do you have 20%, 40%? I didn't want any more questions, so I just said 1/3. So 1/3, 1/3, so it's a beautiful pie chart. And when you look at it, this is how we separate the assets. Up until now, all you've worried about is how should you invest the money to give you the highest rate of return you can get so you have the most money available in your pot at retirement to provide you the most income, right? That's what you worried about. You didn't worry about principal protection lifetime income because you were making your salary. You didn't worry about liquid assets because you're not overspenders. You never spent more. You don't have a lot of credit card debt. So you got to the point where all you worried about was growth, growth, growth. The issue now is the most important thing we look at for retirement is how much income do you need for the rest of your life? And that's the biggest question we're going to have for our clients. And it's funny because people come in just like you and we'll say, okay, number 1 is how much income. They'll say, we have no idea how much income we need. I'm like, are you crazy? What are you talking about? Oh no, we don't know how much we need. You to help us figure out how much income we need. I'm like, how do you not know how much income you need? And I'm teasing them a little bit. And they go, we just don't know. What are you talking about, Dan? I said, you need to know. It's very simple. Guess how you can tell how much income you're going to need each month. It starts with a B, and it's a word you don't like. It's called a budget.
Budget.
So before we do the planning, we're going to help you create a budget. And it's not going to be a tight budget that makes you feel restricted. It's going to be what we call the golden retirement budget that calculates out every expense you're going to have and to make sure we have more than that coming in per month so you don't have to worry about your money. Okay? That's number 1. Second, then, we're going to worry about how much liquidity you need for the home remodel, for buying a new car, for helping your kids or grandkids with education, etc. And then we still are going to have growth in our portfolio, but it's going to be number 3. Growth is nowhere even close to being number 1 in any way, shape, or form once you're retired. So if you, at retirement, not before retirement, focus on red. You're at retirement or 5 years of retirement. If you focused on income as number 1, liquidity is number 2, and growth is number 3, do you think you'll have a less or more successful retirement? Significantly more successful retirement because retirement is all based on the amount of income to drive your lifestyle. So what does this mean? If we use the green bucket, let's say you're not one of the lucky 1 out of 100 people that has $200,000 of pensions coming in, you need pension type income, we're going to use the green bucket, and we're going to use what are called contractually guaranteed insurance products, fixed index annuities with an income rider. I'm like, oh my gosh, Dan said the bad A word. Well, it wouldn't be the bad A word if I'm talking about a variable annuity. Because a variable annuity will go up and down with the stock market just like your current portfolios will do, and you could be paying up to 6.5% per year in fees. Would you ever buy that if someone told you that? Heck no, it's just no one told you that. So unfortunately, probably 20% of you own a variable annuity in here. So we have to find out, do we have to keep it, or is there any way we can modify that and enhance it? You might have to keep it, we just make it part of your plan. But what if, and you don't have to believe me yet, what if I could tell you, we have this green bucket, we got principal protection, guaranteed contraction, no losses, income guaranteed at the highest level for as long as you both live, regardless of the stock market crashes, some gains when the market goes up without risk, potential income increases, and has some of the lowest fees out of any asset we can put you in. In fact, usually it's going to be significantly lower than the asset management and mutual fund fees you're paying currently. If that were true, is that okay for some of the money we need to create guaranteed income from? Of course it is. Second is then we want money in the bank, but we don't want money in the bank for emergencies. We want money in the bank because it's easier to spend. It just makes you feel more comfortable, and we just don't want that money. So let's say you have $200,000 of money in the bank when you start your plan. Every month, if your budget's $10,000, we don't want to create a plan that gives you $10,000 of income per month after taxes. We want to create a plan that gives you $13,000, $14,000, or $15,000 of net income. We want you to have $3,000, $4,000, $5,000 more to spend than you need. What do you do with that $3,000, $4,000, or $5,000 each month as it comes in and you don't spend it? Add it to your gold bucket. And if you want, you can add it to your red bucket. Okay? And we still want growth inside of the portfolio. We're going to use all managed assets, low-cost funds, either ETFs or stocks, which we should use, momentum-based, but our whole focus is stopping large losses. We're going to use stop losses, and there's no trading costs as we make the trades on a monthly basis. So this is how we design portfolios as far as what we help with. But I'd say 1 out of 5 of our clients has real estate, not their house, but investment real estate. And if you own real estate that is paid off and paying you net income at a high level, that's a great asset to own during retirement. If you own real estate where you have high loans and you're getting 0% or minimal net income, dump it. Okay? Everyone just is going to tell you dump it anyway. No. If it's paid off and giving you a high level of income, is that a good asset to own during retirement? It's awesome. If you're not getting that income off of it, you're losing the value of the equity you have in that property. So you have to do an analysis to find out should you sell it. But a lot of our clients have real estate. As long as it's positive, we put that into their plan, and that's a great source, almost like kind of like a pension, right? It's coming in month after month after month. And then about 1 out of 8 of our combined clients wants to manage some of their own assets. So we had a client come in, they had about $3 million of assets, and he was tired of managing the money because it was just so volatile. She was freaked out by him managing the money. So at 70, they said, we need to turn this over to someone because he's worried if he's gone, how is she going to understand the plan? So we said, okay, we'll definitely do this for you. And then we did the plan, and they said, how much do you want to manage? He goes, nothing, just put it all in your plan. So I put it in the plan, but then as I was thinking while they were gone, I went through and I'm like, I'm not going to do that. So he didn't give me the number, so I just made up the number. I said, what if we kept 10%? What if we kept 300,000 of it just over completely self-managed for him, and I can make the plan work with 2.7 million? And I presented it to them both. And first they were like a little fidgety because there's still money in the market. I said, in his high-risk market, we're gonna have money here, but in his high risk, and I said, what if that doesn't affect you? What if you could lose all 300,000 of it and will not have any effect on what your financial success during retirement will be? Is that okay then to allow you to continue to manage 300,000, which you've been doing for the last 40 years, so I can't imagine you want to give it all up. He goes, I don't, but she wants me to. I go, is it okay if he manages 300,000 if I can then protect you with the rest of the plan? She said, yes, that's great. So it fixed their marriage. That's simple. Right? And that's what you have to do. I tell every one of our clients, as I'm talking to you right now, that if someone would have told me 30 years ago, Dan, you're going to do all these numbers, but only 10% of your job is going to be numbers. I'm like, what the heck's the other 90%? They said, as a psychologist and a marriage counselor. I'd say, there's no way. And it's exactly what I've become, and I'm really good at it. So let's look at then how we layout, because this is how we design a plan for every single client. Well, here, if we look at our growth assets, how do we manage those monies? Well, we're going to do technology driven. If we have 48 assets, stocks, and mutual funds, we're going to rank them every month from 1 to 48, pick the top 12 for the portfolio, realign them based on how much volatility they have, exclude the bottom 36, and we're going to run a 60% stop loss on a daily basis to find out should 60% be taken out, and then we're going to run the other 40% stop loss. And then we're going to eliminate the bottom 36 for the next month. And every month we're going to rerun it again. That's how the money is managed. And it's just system-based. We don't make any emotional decisions. How about the green bucket? What do we do this for? The only reason we do it is for principal protection and guaranteed lifetime income. Nothing else. And if you do that, let's look at the principal protection first. So this is the stock market from 2000 to 2024. If you had $1 million, earn S&P 500 index increases or decreases, it shows $1 million would have grown to over $4 million. Pretty good gain, right? Quintupled the money. That's what would have happened. Literally. A lot of volatility, so even though it grew, how much income can we take out of something that acts with that much volatility? Minimal. No matter what, doesn't matter who you are, you have to say minimal. So, what does that mean? Well, now let's go back to 2000. Let's say you had an old school annuity back then. And it was indexing where they gave you no losses, but you couldn't earn more than 6%. All of them were almost caps back then. They weren't really high. Well, now instead of this sexy, exciting red line, you get boring turtle, snail, blue line. But boring, how much income can we take out of that? A lot more. Well, let's look at how long it took sexy to catch up to boring. 2019, before the red line actually caught up to the blue line. Is that a long break even or a short break even? Not break even. The only reason we're up here is because from first 2009 on, we had 0% interest rates here. And then in here, the government put $10 trillion of our money into the system by giving people money to stay home from working with COVID. Market shouldn't be where it's at now. It's there because it's 0% interest rates and $10 trillion of our money that they put into the system. So that's the principal side. How about the income side? And I call it anytime income because if you go do research on it, you go, oh my gosh, people told me I'm 65, I can't put money in annuities, they can't touch it for 10 years. Well, unfortunately, they're right with a lot of annuities. You cannot touch it for 10 years. But we're going to use anytime income plans, which means we can take the income out right away, even within 30 days. So let's say you're married, 65, income's guaranteed to be paid for joint life, doesn't matter how long you live, doesn't matter if the stock market crashes, doesn't matter how much your account earns, the remaining assets are paid at death to your beneficiaries. So what does this mean? Let's say you have $1 million, you're 65, you put the money in. You can immediately take out jointly $69,000 of income, and that's at a 6.9% payout rate, and it'll last guaranteed for as long as you live, which is higher than any other guaranteed rate you can get right now. But what if we can defer it for 1 year and your $1 million, even if the stock market crashes, never loses money, and your income value guarantees to go up to $1,085,000, and now because you deferred it 1 year, your income's $75,000, 7.54%. What if, like most of my plans, I defer this asset bucket for 5 years and I use the gold and the red bucket first? What if your million could be contraction guaranteed to be worth 1.425 million for income purposes? And if you deferred your 69,000 till now, you're going to get 104,000 or 10.47% guaranteed payout. Would that then make you feel comfortable that you're going to have a secure retirement, knowing you're going to get paid 10.47% of your original investment for as long as you live, regardless of what happens in the stock market? It's going to put you in a position where you don't have to worry about things, and nothing else can do this for you. The longer you defer, the more money you get, but you don't want to defer longer. You just want to defer until you hit your income goals. How about this then? Most important thing is have a written retirement income plan. Our planning process is different than anybody else you talk to. We do education, help you determine goals, create your retirement vision, gather data, so we can analyze your risk, funds, fees, and your budget. And that's how we're able to create the 4 things you don't have. You don't have a retirement income projection, you don't have a tax analysis, you don't have a legacy plan, and you don't have all the plan in writing because you haven't gone through a process. So here's a quick case study. Bob and Carol, 65, retired a couple years ago. She was a state employee. He was an engineer. She gets $24,000 a pension. They get $26,000 and $28,000 of Social Security. So they have $78 grand of fixed income, which pays for all their needs, but not their wants. And they have $1.6 million. They saved good. And they want to travel a lot, but they're not using it. And they know they can travel better now than if they wait. But they're worried about the market being high, losses, money running out, taxes, fees, beneficiaries, volatility, etc. They had a broker for 22 years. They think of their broker more as their friend than their broker. And he keeps promising them a written plan. He's never given them one, so they came to us because they wanted a written plan. So the first thing we do if you have a broker, we say, what are you paying in fees? And they said, we think about 1%. And we're paying about 1%, 1.25 on their stocks, but they were paying 2.92 on their mutual funds, 4.61% on the variable annuity, nothing on the bank. 3.08% was their fee, not 1. So they're paying $49,000 on $1.6 million. That's the fees they're paying. Everyone thinks that's the worst, but it wasn't, because we asked them, how aggressive are you? They said, we're not aggressive at all. We're ultra conservative. We don't want to lose much. I go, well, how much do you think that is? And they said, kind of like you said, like 10%. So we did an analysis and it shows if we have an 08 crash, their stocks are going to lose 100,000, mutual funds 500, variable annuity 190, nothing in the bank. So they have to stay at 65. They're okay losing 790,000. They're okay losing 49.4%. They're okay if they need a 97.5% recovery gain. Are they able to say they're okay with all those? No, it's just no one has ever told them that in writing. So then we met with them, we put a plan together where we allocated their assets this way, $200,000 in the stocks. We had him self-manage because he wanted to manage it. We put $800,000 into the guaranteed income bucket, $100,000 in the bank and not $20,000, $500,000 in the growth bucket with a stop loss, the same $1.6 million. But now their total fees we got down from 3.08% in writing to 1.07 from 49,000 to 17. And I know a lot of you are thinking, why would you reduce the fees, Dan? We know you get paid by the fees. Well, if I can reduce anyone's fees from 49,000 to 17,000, even if they hate me, is it guaranteed they'll become my client? They'll become my client. And then I'm going to tell you, if you're happy, we want you to refer people to us. Is that okay? That's how we do our business. Now, this was people thinking this is the best part. It wasn't. I think the risk part was, because now, if we have a market crash, the stocks that he's managing, he's still going to lose 100,000. We're not going to lose anything in the annuity, nothing in the bank. If the market goes down and we lose 10% of 500,000, we lose 50. So we still have risk, but it's 150 or 9.4 versus 790 or 49, and the recovery gain's only 10 versus 97, which means effectively we reduced their risk by 90%. Would that then make them feel a little better? Now, this isn't the best part. The best part is we're going to show them how they're going to replace their paychecks, because they have no idea how they're going to replace the paychecks for the rest of their life. And first, we're going to show how we allocated their assets. Then we're going to show the first year where their income's coming from. PERS, Social Security. That's what they were living on, 78 grand. We added $50,000 a year for the first 5 years out of their non-qualified after-tax account, $20,000 out of their managed stocks. So now instead of $78,000, their income's $148,000 before tax. And then at age 70, at that point, we take less money out of the after-tax non-qualified, and we turn on 10% guaranteed income for her, 10% guaranteed income for him. If either of them die, the survivor gets it. So we have $80,000 in guaranteed joint income. If they both die, whatever's left of all their assets are passed on to the beneficiaries. But look at what their income increased to then. Is that a good income plan? Makes it easy. But let's look at the tax side. So this is their Social Security. 85% is taxable. Pension is taxable. Of their non-qualified portfolio with dividends and gains, $50,000, only $15,000 is projected to be taxable. Their self-managed stocks, they have about a 50% gain in there, so half of it's going to be taxable. So 148 is their gross, 94.9 they report. Standard deduction, that's their total federal and state taxes. or taxable income, that's their total federal and state taxes, divide that into their gross income, they're only going to pay 7% federal and state taxes for the first 5 years of their retirement. So we get them a retirement present of only paying 7%. Is that a pretty good retirement present? Their gross income, that divided by 12 is 12,333. Taxes divided by 12, we have 898 withheld. They have 11,435 net. Their budget was 8,100. They have $3,285 more to spend per month, $39,000 more to spend per year after taxing the budget than they need. Are they set then for retirement?
Yeah.
It's exactly where they need to be. Now, once we do this, a lot of times when we show this to a couple, they'll first say, we don't care if the kids get anything because we're so worried about ourselves. They have no idea if their plan's going to work. Then guess what happens? If you show them their plan's going to work, who do they worry about?
The kids.
The kids. So then we do a legacy analysis and we show them, okay, this shows how much income you're going to get out of your assets, not including pension, Social Security. Here's the cumulative amount of income you're taking out. So by 85, you're taking out 1.8 million. You only got 1.6 million. Does it seem weird that you took out 1.8 million by then? Should seem weird because it's like, okay, I used up all my money. Well, assuming we get a 5% rate of return on all assets, 4% in the bank, 1.5% on real estate appreciation, they have a current net worth of 2.6 million. At age 85, they took out 91,000 from their assets. They're taking out 1.8 million total. If they just get a 5% rate of return, take out 1.8 million, they'll still have 1 million in their portfolio, 227,000 in the bank, assuming they don't make any more deposits. The real estate went from 1 million to 1.3. So how would you like to start at 2.6 million, take out 1.8 and spend the heck out of it, and by accident leave your kids $2.6 million? Isn't that what you want your money to do for you? Every single client wants it this way. They want to start with an asset value. They want to take as much income as they can, but they don't want the asset value to go down, and they want to pass the same or larger amount on to the beneficiaries. And that's what we're able to do when we do the proper planning. So a lot of people say, well, we saved it, but we don't understand our plan. Well, it's not that you don't understand your plan. You don't have a plan. So how can you understand it? So we have to then write out a 12 to 24 page written document that explains every single thing about your money. We're going to read it out loud. My partner and I will both sign it as your fiduciaries. If you got this in writing, now we're responsible and accountable for it. Do you think now you're going to understand your money and we're going to make sure everything is going to happen for you? And here's our entire planning process. Don't settle for less from your advisor. We have a minimum 3 appointment cycle. We can never do a plan in 3 appointments. We just have that as our bylaw. It takes us on average between 5 and 8 appointments before we can complete a plan. Why? Because we need to do things that haven't been done for you. We need to create a full retirement income projection and an income tax analysis based on your budget. We need to do the legacy analysis. We need to then write out this entire plan. So everyone, when you look at this, every single consumer in here, every single retiree, soon to be retired, you say, gosh, I want these services, but all these things look expensive. It has to be expensive. You're at this restaurant, you wear your cufflinks, whatever it is, it has to be expensive. And I say, well, it should be because as a certified financial planner, if you just came to me as a fee only, I could charge you $5,000 to $10,000 for these plans. The issue would be we'd get so much less clients. So my partner and I decided we're not going to charge you any upfront or ongoing planning fees. We're paid advisory fees for asset management and commissions from insurance companies, just like your current advisors are paid. So we don't make any more money than they do as a percentage basis, but we get a lot more clients, so we make a lot more overall money than they do. And if you're happy with your plan, what are we going to ask you to do? Refer people to us. That's when we make our extra money. So you got 3 choices to plan for your retirement security. You can just say, I'm going to keep doing it myself. I like it. But you're going to worry you're making bad decisions. But more likely, if you're managing the money, your spouse is going to worry that you're making bad decisions. You're going to worry what are your next steps, and you're going to worry you can't sleep. Or you just work with your current or new traditional advisor, and they say, hang in there, ride it out, you'll be okay, don't worry, the market always recovers. Or we're just going to put you in the tried and true retirement 60-40 stock to bond portfolio, you'll be fine. And you don't need a written plan, you have me, your advisor. All those are problems, so just let us help, because all these issues up here are big problems that are going to hurt your success. Our specialty is building customized written retirement income plans, written document that provides a comprehensive actual plan for everything about hitting your retirement success, risk assessment of your current assets showing how much you could lose, and then how much we can lower your risk by your new portfolio, fee analysis showing your current fees, and before you invest with us, all your fees in writing before you invest, which is how it should be. Retirement income analysis showing where your income is going to come from for the rest of your life, so you can see that you have replaced your paychecks. A budget showing the income you need each month. An income tax analysis showing how much tax you'll pay, net after-tax monthly income, and monthly excess cash flow. Legacy analysis showing how much you can potentially leave your beneficiaries after you're gone, and the entire plan in writing signed by your advisor. If you have that, you won't worry about your money. So right now you're at a crossroads in your plan for retirement. You can say, oh yeah, that Dan guy, he's smart, but you decide, even though you want to make changes, you want to keep doing the same thing. Stay at your current advisor, keep managing the money yourself. If you do the same thing, you're going to keep risking, keep worrying, and keep going without, just like you've done so far. And Albert Einstein calls that the definition of an insanity, doing the same thing over and over again, expecting something different to happen. It's not going to happen. Just let us give you a free second opinion. We can teach you how to protect your money, increase your income, reduce your fees, and feel secure and enjoy your life. That's the only way you can learn to take back control of your money. And if you look across the nation, how many people across the nation do you really think feel like they're in control of their money right now? And the ones that feel like they are, do you really think they should feel like they are? Those are the ones that should probably be even more so worrying about their money. So if you're serious about creating a safe, secure, and written retirement plan, we can help. Our typical client has between $1 million and $10 million, $20 million of assets. The minimum is $500,000, so we can work with you. And here's my big, hard sales pitch to you. We're going to sit down with you one-on-one. We'll find out exactly where you're at and what your goals are. We're going to actively listen to what you want to happen. Not us, but what you. Meet as many times as needed, not charging any fees. We're going to design an actual written plan for you. We're going to give it to you. You get to take it home before you're a client. We're going to show you how to reduce your risk against large losses. Never ever say hang in there and write it out like everyone else tells you. We're going to create a dependable active income stream that can replace, and we'll show you, replace your paychecks. Invest for growth without excessive risk. Understand your money for the first time. Help you stop worrying about your money. And at the end, we're never going to obligate you to do business with us. You can meet with us 8 times. We'll give you the plan. You can take it home. We'll give you all kinds of free advice. You don't have to do business. If we do it this way, do you think we get less or more clients? We get way more clients, and then we get those clients to refer people to us. That's why we do it this way. So everyone has this in their packet. Go ahead and take it out. Their little appointment card. And at seminar, I wait till they all take it out. I'm not moving or saying anything else. I know they're hungry by then, so they need to take it out.
Oh, it's before eating.
So everyone take it out. Now, if you want to meet with us, assume this first meeting is going to last 2 hours. And the first meeting will, in a lot of cases, just cover meeting each other outside of this seminar and finding out, can we help you? And do you agree and think there's help? So fill out the top part up here, your name, spouse name, home phone, cell phone, because that's where we're going to send you reminders. And make sure also you circle whether you have $500,000 or $1 million of non-real estate assets or $1 million or more of non-real estate assets. That allows us to prepare data for you for our first meeting. Then what I need you to do is not pick 3 different appointments. I need you to pick 3 times. What is your first choice? What is your second choice? And what's your third choice? We're going to try to give you your first choice. If that's not available, try to give you second. If not third, if all they're gone, we'll come and the staff will ask you what time is going to fit for you. This first meeting, assume it's going to last 2 hours. You don't have to bring any data with you. You can just come by yourself, and then we can find out, are there some things we can work on, then we'll get the data later. But if you want to jump start it, you can bring all your data with you. Either one's fine with us. I'll leave them there for that. Now, what's our offer? What's the worst case that can happen? I always like to look at worst case. You're going to spend time to meet with us and become more educated about your money. And it's amazing that most people spend more time planning their annual 2-week vacation than they plan spending for the next 30 years of retirement. Why? Because planning a vacation is fun. Is planning for retirement fun? No. We'll make it fun because we'll make it successful. You'll receive a free second opinion about your money. You'll receive a free customized retirement income, risk, tax, fee, and legacy plan. Even if you don't become our client, you get to take that home and keep it. We're not going to charge you any planning fees, no matter how many times we meet. Get a free signed copy of our most recent best-selling book, Mama's Secret Recipe for Retirement Success. Get a free signed copy of our 100 Shades of Financial Freedom. Very, very, very beautiful book written about retirement. You get all this with no obligation or pressure to ever have to do business with us. And you can walk away and keep all this for free, guaranteed. Is that a pretty good deal? Yeah. That's how we do it. So fill these out. Staff will come in about 5 minutes. They'll pick them up. They'll bring you back an appointment packet. At the same time, the staff from the restaurant will be coming in. They'll get rid of all your salad plates. They'll bring you your entrees. Make sure you stay because they'll give you coffee and dessert. If you don't want to wait for dessert, tell them to wrap it up. You can take it home. Hopefully you all learned a lot tonight.
Wow.